Hey everyone, Annie Dickerson here. And on behalf of Julie Lamb and the entire Goodegg Investments team, I'm thrilled to welcome you to another episode of the Life and Money Show, where we talk about all things life and money. And today I wanted to start out by just sharing a little bit personally, as of this recording. I was just in Sedona, Arizona last week, one of my favorite places on all of planet Earth. And I was there for a women's retreat. Fantastic, soulful, deep work, just moving grief and rage and getting to the heart of things so that we can experience that lightness of being, the joy, the kindness, the compassion, all of that, and doing that in sisterhood. And it was just, there was nothing like it. But let's look at the occupancy rates. Now, according to CBRE's US multifamily report from Q4 of 2022, the overall US occupancy rates are expected to remain above 95% with annual rent growth expectations of over 4%, which is a very healthy forecast. But here's the thing, although growth expectations remain strong, we're also keeping a very close eye on new inventory to the market because, as you know, that can shift the equation. Now, CBRE expects 450,000 units to be delivered in 2023, adding about 2.6% to the total inventory. And in addition, there are another 300,000 units or so under construction that will be delivered in early 2024. And while we expect these new deliveries to affect short-term leasing activity, overall demand is expected to continue to grow. CBRE predicts that nearly 3.5 million new market rate multifamily units will be needed by 2035 to keep pace with overall demand throughout the US. That's a lot, 3.5 million new units needed within the next 12 years or so to keep pace with the overall demand. So that means there's a lot of room for additional new developments, but also a ton of ongoing demand for the types of multifamily units that we will continue to invest in. Now, according to Berkadia's 2023 forecast, net absorption is projected to reach the second highest level in more than 2 decades. Berkadia forecasts the national occupancy rate to settle at about 95% in the fourth quarter of 2023, down just 70 basis points or 0.7% from 2022. So what that means is that with that net absorption being so high, that means that even with all those new units coming online, they're going to get snatched right up because there's so much demand for these multifamily units. Now, that year-end occupancy rate would be higher than the pre-pandemic cycle average of 94.7% during the period of time from 2010 to 2019. So what all that means is that multifamily continues to be a strong and stable investment. Now, as interest rates continue to rise, renters continue to grapple with the idea of purchasing versus renting. I mean, think about it, right? If you were on the cusp of buying a house within the last several months or a year, and you're watching as these interest rates continue to climb, you're going to look at your purchasing power and you're like, oh man, all of a sudden I can't afford that $1 million home. Now I can only afford 700,000 or 800,000, right? Because those rising interest rates impact your monthly payments. You're having to pay more in your mortgage and interest because those rates continue to rise. And so your purchasing power comes down. And so a lot of people are saying, well, I might just wait. I might not buy right now. I might continue to rent. And so that's keeping that rental demand stable and high. CBRE calculates that the average house payment for newly purchased homes in late 2022 was 57% more expensive than the average monthly apartment rent, which is the widest cost gap on record. Now, even if home values continue to fall and mortgage rates drop in the latter half of 2023, the relatively lower cost of renting will continue to keep multifamily demand strong, which is partly why we continue to be so bullish on multifamily acquisitions and the multifamily rental market in general. All right, now let's shift because I definitely want to talk about strategy with our existing portfolio. Now, a lot of people, there's a lot of excitement when it comes to acquisitions, right? You got this new property. I remember when I was investing in rental properties, that was my interest too. I was like, oh my gosh, looking at the markets and underwriting the deals. The excitement is when you buy, right? But to actually see through to fruition those final returns, you've got to maintain that excitement throughout the hold period. And that's what we love our asset management team for. And because they keep that excitement, they love all the little details on all the ongoing improvements and refining that strategy over time. So even with the strong performance of the assets within the portfolio, trust us, we continue to keep our finger on the pulse. We're not sitting back. We're continuing to refine and shift our strategies to meet what's going on with the larger market and continue to monitor the debt and the cap rates for opportunities to secure and enhance the assets and our debt positions. Now, as part of this, we are continuing to build up the reserves for each of our assets in our portfolio to further bolster the health of each property and thereby to further protect your investment, right? It's like, it's common sense, right? Like with my kids, I tell them, they're like, oh, I want to buy this, I want to buy that. I'm like, well, how much money do you have in your savings account? They each have a debit card and savings account. And if they haven't saved up that money, but they find that great thing that they want to spend money on, well, you're out of luck, right? You didn't save up the money. You didn't have those reserves in place so that you would have that money in case you wanted to or needed to spend it on something. And that's the main strategy I wanted to talk to you about is with each of our properties, we've really taken this time to bolster the reserves on every asset in the portfolio because just like you, we don't have a crystal ball. We don't know what's coming down the pipeline. And so we want to be sure that we are protected, that your investment is protected, that it's got plenty of buffer in place. So we don't need to go to you for a capital call, that those reserves are the first line of defense. If anything is needed on the property that's unexpected or anything happens, we have those reserves in place. And that's also part of why, if you're investing, if you've already invested with us, you might be seeing some lower cash flow on some of your investments. And that's on purpose. There are some operators out there who are continuing to send out the same cash flow distributions that they have in previous years. And the reason that we're not doing that is because we want to be proactive. We are intentionally, even though it's not fun and it's not easy, and we're investing right alongside you. So our distributions are going down just like yours, but we're making that strategic decision to hold back on cash flow distributions so that we can keep more money with each of these assets. And in fact, nearly all of the assets in the Goodegg portfolio have reserves above and beyond $1 million to provide ample buffer and to cushion and protect your investment. So here are just a few examples from the Goodegg portfolio. We have Royal Spring, which was part of, actually, Royal Spring closed a couple years ago. I'm thinking of the Sarah at Lake Houston. Well, both of those properties in Houston, Texas, have right around $2 million in reserves apiece. Waterley, which we were just talking about in Wilmington, North Carolina, we have current reserves of 1.75 million. And Congaree Villas in Columbia, South Carolina, that's a bit of a smaller property at just over 100 units. We have over $1 million in reserves, and we're just trying to do everything we can to build up those reserves, because it's all about the delayed gratification, right? It's not necessarily about getting all that cash flow right now. It's really about making sure that those assets are protected, that your money is protected no matter what comes, so that you don't have to put more money in and you don't have to worry about your investments. So you might be seeing some lower cash flow now, and certainly for any additional multifamily acquisitions, any additional multifamily investments you're making, you might be seeing that lower cash flow, at least for the first couple of years. But that's in large part because of what we're seeing in the economy right now, and our strategy to make sure that we are really focusing on the health of the asset, and not just paying out returns to pay out returns. So just a little bit of the thinking behind the scenes, so you better understand what we're doing to, like Sabina says, stay in the pocket. We're trying to stay in that pocket. All these things are trying to knock us off our beat, but we got to stay true to that beat. We got to stay in that pocket. And so building up those reserves is a big part of what we're doing to stay in the pocket no matter what happens.